Welcome back to the Mountain Morning Show, and I'm joined by Travis McGhee of FuturesANIMal. How are you?
Good, Joe. How are you?
Doing really well. And so are jobs numbers.
Yeah, they were impressive last week. A little outside of what I might have expected. I think outside
a little
of
bit everyone, yeah.
Yeah, most have expected. What was a little curious, or what made me curious, was had you told me ahead of time, and you and I have talked about this, had you told me ahead of time that jobs were going to be up more than, non-farm payrolls up more than 200,000, and the unemployment number was going to go down to 7%.
Yeah.
As crazy as it sounds, I would have said that the market would have been down substantially.
Right.
And a lot of that is predicated off of what's happened recently with, the Federal Reserve is looking, or so we think, they're looking for a reason to stop the stimulus program.
Right, start moving the numbers
up. Yeah, and to start, well, they're not necessarily going to touch interest rates, but they're going to start scaling back the $85 billion a month that they're buying in longer dated treasuries. So what does that mean for the average everyday person? It doesn't mean a whole heck of a lot. But what it does impact is the market. Right. Because there's this perception that there's a lot of free money rolling around, and it's by free I mean it's very, very low interest rate, and while it's hard for us as average individuals to take advantage of that, larger corporations can, and it's cheap for them to issue debt, so on and so forth.
So why didn't the market react in a big way?
That's
it didn't have a snap like it normally would.
My thought has always been. We've been bantering back and forth and speculating and talking and guessing about what the Federal Reserve's going to do for a year now. Right. Really, well, not quite a year, probably since May, since Ben Bernanke first came out and said, listen, if the economy gets any stronger, we're going to start scaling back. And everybody freaked out, and interest rates went through the roof, and the market came down, and everybody's like, oh my gosh, we can't survive unless we have the Fed helping us out.
Everybody was mad at Bernanke for saying it, and then he backed down.
My thought has always been, if the Federal Reserve is going to taper, which they are, it's inevitable, they have to at some point in time, the economy is going to be on such solid footing that in theory it really shouldn't matter. Everybody should be happy that we're growing the way we're growing. So I think that one, a lot of it was already built in, that people have already talked about it till they're blue in the face, and the market, really didn't have much of a reaction to it.
There wasn't any bubble in there.
But two, I think that people are just genuinely happy to see the economy turning around. While it's not significant, there are signs that it's getting better.
Well, 7% unemployment is certainly a really good number.
It is a really good number, and you certainly still have your naysayers out there that say, well, the jobs number can't, it's not necessarily
not reflected
a true
because people aren't looking.
Things like that. It's hard to say. But bottom line, we've had some solid GDP numbers come out. We've had some solid employment numbers come out. We've certainly had very good manufacturing numbers come out. So all signs are starting to point to, hey, the economy's starting to develop a rather strong footing. Maybe it is time for the Federal Reserve to pull back on their stimulus program and for us to, over time, kind of let interest rates track back to a more normalized level.
Sure. When we think about that, it's, as you mentioned, the unemployment rate is only a part of this. I think you're right. And obviously, it makes good sense. I think right now, if the market's not reacting to that, then it's not going to react much more to him saying, "Hey, we're doing it," or I should say, now that he's gone, it's his former assistant. That being said, there are still other things that we're challenged with, and one of them is going to be the fact that we have to approve a new budget, and that happens, they're hoping in January, but more likely kick the can down the road again?
There's a lot of speculation coming out. There were some yesterday that they don't think it's going to be as bad as it was last time. We've got a few individuals, a bipartisan committee
that's working the deadline plans,
figuring something out, and word is that they might have something that everyone's going to agree upon. Now, I don't know if that's necessarily the case. I don't know. I tend to think we're still going to have a rather rough period come January, February. There's going to be some political bickering back and forth, which is never good for the market. So what does that mean? Well, I think that, again, what's got people scratching their heads right now, and worried is, again, you turn on the TV and you see this all-time highs. The market's at all-time highs. It's at all-time highs. And then everybody starts to say, well, people are naturally scared. You know, we just came out of 2009, where in 2006, 2007, we heard similar type of wording, and people are like, oh man, we're back to where we were. Naturally, we're gonna come off of that. The market's gonna sell off. It's gonna be bad. So people are naturally scared of that. Again, as we've said before, I don't think that by any means we're in a bubble territory. Now, with that said, that doesn't mean that the market will not correct one way or the other over the course of the next couple months, which I think it will. But I just think it'll be a natural short-term pullback in the market. Nothing that anyone really needs to be fretful of and worried and start making massive changes to their 401k to get around. But yeah, we do have quite a bit coming at us at the beginning of the year.
Sure, we do. I think people are skeptical too. I think that especially the private investor is very skeptical because, frankly, I think that the budget fighting that we had, I think it did kill Christmas, so to speak. I don't think we're going to have an okay Christmas, but it's nothing like it could have been. I think we've seen those numbers that are already kind of proving that out. Then, of course, having the budget problem right at the beginning of the year when people start thinking about paying their bills, and the government's finally talking about paying theirs that they should have been paying, a year ago. This situation, I think, doesn't lend towards the individual person feeling very confident, which I think sometimes has some bearing, doesn't it?
And yeah, it does have bearing. And confidence has been an issue for the retail investor for a number of years now, certainly since 2009. All of this that we're talking about is short-term oriented. And there is always going to be issues like debt ceiling negotiations, budget negotiations, geopolitical issues all the time. There's always going to be something like that. But as an economy, as a market, as corporate America, we have much stronger balance sheets. We're sitting on a lot more cash. We are in a much better financial position than we ever were in 2005 and 2006. So
that's impressive.
Yeah, it is impressive. And so personally, that I'm not worried about our market moving forward. Will there be pullbacks? Yes. But for the average, everyday retail investor, that does not mean you should not get involved in the market. And it certainly means that a retail investor should not be trying to time the market. Again, if you're getting involved in a disciplined way, you're diversifying your assets and you're picking your places and you're developing a solid plan, these little short-term bumps in the road really don't matter all that much to you. They certainly make good news. They make good media. It's fun. It creates good ratings for television stations.
Yep.
But for the everyday investor who's trying to build long-term wealth through a 401k, an IRA, whatever the case may be, it really doesn't matter all that much.
We have just one moment literally left, so just speak quickly on what that means for stocks and bonds at this point. For
stocks and bonds, I think through the rest of the month, I think stocks are going to continue to trek higher. Okay. I think we're going to hit a rough patch in the road maybe in January and February with the next debt ceiling negotiation and budget negotiation. But I think in the long term, I see a lot of hope for stocks. As long as we continue to grow earnings and grow revenue with corporations, which right now we're having a hard time with. But if we can build on that, I think stocks will continue to grow. And bonds, again, bonds are going to be kind of tricky with what happens out of the Federal Reserve. So
we'll see what happens. Yeah. All right, Travis McGhee, Futures Animal, the website.
FuturesANIMal.com, Joe.
All right. Thanks for being here. Appreciate it. It's a good heads up as we move into the end of the year. So start planning your future right now with Futures Animal. We'll be back with more Ramp Sports this year and also Summit County right after these messages.